When I first started investing, well, investing is not the correct word here. I was not investing, I was speculating. And I made my fair share of mistakes. But what I realized is knowing and understanding your mistakes is one thing. However, you need to have a system in place so that you do not make the same investment mistakes again. In investment, emotions and people psychology plays a vital role. Even if you know the basic investment mistakes, there is a high probability that you will make the same mistakes again consciously or unconsciously. Therefore, having a system in place that makes sure that you are not doing any known or at least beginner's investment mistake is very important. During my investment journey, I felt that there is a lot of material on success stories, failures, and mistakes. However, there are very few to no material that covers or talks about a system to protect yourself from such mistakes. Therefore, in this video, my motive is to share the system that I use, which really works well for me. It is not a set in stone system, you can adapt it as per your needs and financial goals. So the first beginner investment mistake or trap is pseudo certainty trap. This phrase is an observation of investors' perception of risk. Investors will limit their risk exposure if they think their portfolio or investing returns will be positive. Essentially, they are trying to protect the lead. Well, on the other hand, they will seek more and more risk if it looks like they are heading for a loss. Sounds familiar? Book a gain of 20% on an investment and hold the bad stock in a hope to recover the losses. Basically, investors avoid risk when their portfolios are performing well and they seek risk when their portfolios are floundering. This is largely due to the mentality of winning it all back. Investors are willing to raise the stake to reclaim capital but not to create more capital. Let's try to understand it with another analogy. Assume you are a race car driver. How long do you think you will survive if you only use brake when you have the lead? If you have a lead, you would want to hit the gas even harder to maintain the lead and further increase it. You would never brake or stop just because you have a lead. Same goes with your stock investment. If one of your stock is doing good, you invest more in it and not the other way around. There is another term used for this beginner's investment mistake. It is called loss aversion. Loss aversion is to be afraid of loss. Warren Buffett said never lose money, that is a good rule. But if you are too loss averse, you may actually end up losing more than if you weren't. I see this aversion so many times and I have caught myself in this as well. If you, for instance, have a stock that has a return of minus 10%, a person with loss aversion may be so afraid to take the loss that they hold on to the stock for no other reason than to not take a loss. Then the stock perhaps falls to minus 20%. By being too afraid to sell the stock, you actually lost more. Please note, I am not saying that you should always sell a negative stock. What I am trying to say is the sell decision should not be based on an aversion towards loss. Best example to understand it is selling of airline stocks by Warren Buffett. He took the loss on his investments in airlines and used the rest of the money to invest in stocks that looks promising and will perform better during the current situation. That decision made him a fortune. Warren Buffett didn't sell his stocks because the stock was 50% down. He sold them as the fundamentals have changed. Loss aversion does not mean sell anything that is negative. Sell a stock irrespective of whether it's negative or positive if the fundamentals have changed and you think the company is not that attractive now as it was before. In other words, if Warren Buffett would have held on to his investments, he would have averted the loss but would not have made the profit he had now. So the goal is to make money and not to avoid loss. Now we understand the first beginner's investment mistake. Let's check the system I use to make sure that I do not repeat or make this investment mistake. Firstly, I have created a list of investment traps and always keep them by my side when I am planning to invest my money in any type of investment product, be it stocks, real estate, gold, or any investment. It's like a checklist for me. And I'm a big fan of writing important lessons by hand on a notebook. This way, the idea sticks to my mind better than if I would have typed it on a notepad or sticky note digitally. So I would highly recommend you to take a diary or paper and write all the money traps and investment mistakes you know or learn after watching this video in your own words. Trust me, try it out. Then I ask myself why I am making this investment decision. Is it because I don't want to take a loss? Is it because I am too emotional? Or is it because company is really good and its stock is available on a discount? Then I try to find the reason for the drop in the price. Is there something wrong with the company, or a new competitor is in the market, or an event has occurred which has influenced the overall market behavior? For example, the current pandemic, or elections, or trade war. If I find that is just a market noise and company is solid and is on the right path, I will keep my investment in that company as is. Please note, I haven't yet decided whether to increase my investment in this stock or not. To do that, I will check which other investments of mine are doing better, if any. Usually there are always some stocks in a balanced portfolio that perform better than others. It's like you are in a class or a group, there will always be someone better than you in something. Same goes with stocks. In other words, if you have to increase your existing bet on a player in a football team, will you increase your bet on a player who is winning and is in good form currently, or on a good player who is not performing or winning nowadays? I am sure you will invest on a player who is performing good these days. So why not use the same analogy for stock investments? To put it in simple words, winners win. So invest more in your winners. However, if you already invested in a loser stock, but you think the company is good and will come back sooner or later, I am not saying to take out your already invested amount. I am just saying before adding more to it, revisit your winners and add to them. Reevaluate your bad investments and let them lose if required, as the goal here is to make money and not to avoid loss. Lastly, always look stock charts in longer time frames. Always keep reminding yourself that you are in for a long run and don't get yourself distracted by short-term market noises. So to summarize, I have created this checklist and go through it every time I make an investment decision. In addition to it, I have an analogy and quotes attached to each investment mistake as part of my system. You can create your own analogy or use the one I used. I think a person relates to their analogies way better than any explanations out there. Next beginner's investment mistake is the fear of missing out, or FOMO. This one was thrown a lot around when we had this big bull run in cryptocurrency in 2017. This investment mistake comes into picture when you are so afraid of missing out that you throw your money at everything that moves without doing any research. You do not go into the detail on why this stock or investment has gone up or down. You just buy it as everyone on social media is buying it. Well, there will always be a next big stock or cryptocurrency bull run. Market will crash and we will see a big bull run again. That's how stock market or any other financial market behaves. Do not convince yourself that if you miss the chance of investing in this stock today, you are done for good. I mean, think of investors at the time of dot-com bubble. Some of you watching this video right now might not even have started investing during that time. It doesn't mean people who started investing after it or who will start investing tomorrow cannot make a fortune or haven't made a fortune. So be patient, take your time, do your research, and then invest consistently. So how can you protect yourself from this investment trap? Well, this one is pretty simple. Whenever you want to invest in a company or buy a stock of a company, just imagine that some stranger came to you and asked you to lend him some money. Will you lend that stranger money without asking him a question? What questions will you ask that stranger before giving him your hard-earned money? You must be interested in knowing who is that guy, why should I trust him, what is his idea, what about his team, is there a market for that product, what about the competition, what is different about him or his product, and many more such questions. Exact same questions you have to ask yourself before investing in stocks. Make a list of these questions and while doing your research, use it as a template. Well, let's continue with this analogy further. What if some other random person comes to you and says, "Hey, I know this guy, he has a great idea, I'm investing in it and you should too. Do not miss the train to the moon." Will you trust that random person and invest your money in that stranger? I bet not. Then why let yourself get distracted by strangers on social media? Don't trust anyone blindly. This is also one of the early lessons our parents teach. And now in this time of digital world, we have forgotten this lesson. Remember this lesson before you invest in stocks based on advice of a stranger on social media. So, you did your research and decided to invest in that guy's idea. Will you lend him your money today and take it back tomorrow? Sounds pretty strange and stupid, right? Then stop doing it with stocks. If you believe in the idea of that person, you give him time to use the investment and grow. You will not let some other random guy who also seems to be interested in the idea buy you out. Well, I like this analogy as it makes things simple for me to understand and stops me from doing 3 investment mistakes. First, investing in any random stock without asking questions because I have a fear of missing out. Second, investing based on the advice of some random individual. And third, selling my stocks too early. So next time if you're planning to invest in a stock or crypto, treat that stock or company as a stranger and rest will fall into place automatically. Well, this wraps our second beginner's investment mistake. Third and the last investment mistake or investment trap I would like to talk about is there is a distinct pattern emerging here. It happens with many beginner investors and I am guilty of the same mistake when I first started. I think the problem here is in the mindset, which is to become rich overnight. This mindset forces our brain to find unique patterns and convince ourselves that this is something uncommon and we're gonna make millions using it. To understand this better, let's have an example. Let's assume you are a gambler on the roulette table of Las Vegas. A rational person knows that the odds of a particular number to show up is same as for any other number. Yet, if a particular number appears 3 or 4 times in a row, or any other similar pattern appears, you will start to connect the dots and think that there is a relation between the occurrence of events, which in reality are completely random. So to avoid this investment mistake, one should change his/her mindset towards investing. Always look at the investment from long-term perspective, which is holding a stock for at least 5 years. Do not let yourself get distracted from the patterns in shorter term data. Always look at the charts in longer time frames. Zoom out a bit and look at the bigger picture. As I said earlier, we are in for a long run. Do not let anyone distract you. Always tell yourself that you are stupid and capable of losing all your money, which we are. I would like to take the analogy mentioned in the famous book The Intelligent Investor. In that book, the author says, imagine yourself as an alcoholic. And in order to stop drinking alcohol and taking bad decisions, you have to first accept that you are an alcoholic and are capable of making bad decisions. Similarly, in investment world, we should first accept that we are emotional and stupid and are capable of losing all our money. Once we accept this fact, only then can we work on ways to minimize the risk. Accept that you are a human and not a bot. Never invest based on a pattern that you have discovered or have learned in day trading books. Always go through all your systems that we have discussed in this video. Always look stock charts in longer time frames. Keep reminding yourself that you are in for a long run. So do not let the temporary market noises steer your decision. Focus on your long-term investment goals and trust your research. Make it a habit that you will never click on that buy or sell button if you haven't gone through your investment checklist. On top of it, never invest all your money at a time in a single stock. Invest gradually and consistently. And keep some cash aside so that you have some extra cash to invest when an opportunity shows itself. Like the recent market crash. If you had some cash aside, you could have used it to invest during that time. Similarly, now and then market drops 5 to 10%. Use that time to buy your favorite stocks or add more to your existing winners instead of selling as if you are trapped in a pseudo-certainty investment trap. Perhaps reflect a while on these wise words written by Charles D. Ellis in his excellent book Winning the Loser's Game. The hardest work in investing is not intellectual, it's emotional. Being rational in an emotional environment is not easy. The hardest work is not figuring out the optimal investment policy, it's sustaining a long-term focus at market highs or market lows and staying committed to a sound investment policy. Holding on to sound investment policy at market highs and market lows is notoriously hard and important work, particularly when Mr. Market always tries to trick you into making bad decisions. I hope that you will not make these investment mistakes or repeat them in future. And after watching this video, you will have your own personalized system in place that will protect you from making poor investment decisions and falling a victim of these investment traps. Well, if you like this video, let me know in comments or by liking this video. Also tell me if you want me to make more videos on this topic and share my tips and systems on other investment mistakes or traps. I'm also planning to make a video series on money traps and how you can avoid them or come out of them. If you think that is something interesting for you, subscribe to this channel and also let me know which money trap you want me to cover in this video series.